So in the following video, we're looking at chapter 3, which is the effects on the accounting equation. So if you look on page 78, it shows us a diagram of the accounting equation and how the accounting equation should remain in balance. So we have assets, which we discussed the definition of. We have liabilities and owner's equity on the other side, and we know that these are the elements of accounting. Under owner's equity, of course, now we have capital, drawings, income, and expenses. If we look on page 79, it gives us a list of transactions and what the effect will be on the accounting equation. So we're going to use this when going through the exercise on page 85. So we have the page for smart concepts on page 85 of the textbook, and we'll be working through these transactions. When we're analyzing transactions, we follow the following steps to analyzing. Step 1 would be we identify the accounts involved. When we identify the accounts involved, it would be, for example, if the owner contributed a vehicle, we know owner's contribution, that forms capital, and the owner contributed a vehicle, so the vehicle's account is involved. The same would be when we make a payment for the telephone account. We paid, so the bank account is involved. What do we pay for? We paid for telephone, so the telephone account is involved. So that's how we identify accounts. Once we've identified accounts, the second part is to classify the accounts. Now when we classify the accounts, I'm referring to its classification in terms of the elements. So is it an asset? Is it a liability? Does it fall under owner's equity? Right? And under owner's equity, is it capital, drawings, income, or expenses? Step 3 would then be to determine whether the account is increasing or decreasing. And step 4 is we'll allocate an amount. So using this, let's look at the transactions on page 85 over here. It says, on the 2nd of January, Simon Smart started a business as a computer retailer. He drew 950,000 from the savings account and opened a bank account in the name of Smart Concepts, into which he paid 950,000 rand. So we know in the first transaction, the owner made a contribution. So the capital account is involved. He contributed cash. So the bank account is involved. Now we have to classify these. Capital will of course be classified under owner's equity, and capital will be increasing owner's equity with 950,000. Bank, which we classify as an asset, receiving more money for the business, so the assets increase with 950,000 rand. When we look at this, what do we notice? There's actually two transactions taking place. The first one, he drew 950,000 from a savings account. The second part is he took the 950,000 and opened the business bank account. So there the entity principle must be applied, which says that the affairs of the owner and the affairs of the business should be kept separate. So we're not recording the fact that he took money out of the savings account, because that's his personal transaction. We are recording the fact that he contributed that money to the business bank account. Another example would be if the owner withdraws 10,000 rand from the business and he pays for his child's school fees. We are going to record that he withdrew 10,000 rand from the business, because that's the business transaction. We are however not going to record what he did with the money. So he paid his child's school fees, that's a personal transaction. So we keep those separate. Let's look at transaction number 2. Transaction number 2 says on the 2nd of January, Smart Concepts negotiated a loan from Technobank for an amount of 600,000. The loan is repayable in 4 equal annual installments beginning on the 31st December 2015, and the interest rate is 12% per annum, payable quarterly in arrears. So we paid loan, so our first account there is loan, meaning we received money, so the bank account is involved. The loan account we classify as a liability, bank account we know is an asset. We now owe the bank more, so our liabilities are increasing with 600,000. and our assets is increasing with 600,000 because we now receive more money into the bank. We don't concern ourselves with the repayment at this point in time, nor the interest that is payable, because we just made the loan, so we don't have any repayments as yet, and we haven't incurred any interest yet. Right? It also says that the interest is payable quarterly in arrears. The term arrears means that you're paying after the fact. So if you paid prepaid, it means you paid before. If you're paying arrears, it means you're paying after the event has occurred. So let's look at transaction 3. We're now on page 86. It says on the 2nd of January, Simon located premises from which to operate in Hyde Park. The monthly rent for the premises is 12,000 Rand, and Smart Concepts paid 4 months rent in advance on the 2nd of January. So the first clue there should be that we made a payment, so bank is involved. Bank is an asset, and in this case the bank account is decreasing. Now we need to know how much should we pay. That's 12,000 Rand per month, and we paid for 4 months. So we say 12,000 multiplied by 4, which means we paid 48,000 Rand. Now we need to know what is the contra account involved. The contra account being what are the other accounts involved. We paid on the 2nd of January for 4 months. Right? So we paid at the beginning of the month for 4 months rent, which means we paid in advance. We haven't used the premises yet, which means we haven't incurred the expense. So we paid for 4 months. So let's look at it. So here we would say that we have prepaid expense, also known as prepaid rent. Right? So we can call that prepaid rent, or we can call it rent asset. All the same thing. Right? And this would be then classified as an asset to the business. And that would increase with the full amount. So we're increasing with 48,000 Rand. We're increasing our assets. Now another example of this would be when you purchase airtime. So if you purchase 50 Rand airtime, right? This means that your network owes you 50 Rand. So you're paying in advance. Your network now owes you. Whether your network is Vodacom, MTN, Cell C, Telkom, your network now owes you 50 Rand. Now you've used 30 Rand of the airtime. What does that mean? The part that you used is what we call an expense. The part that still remains, which in this case is left over, is the 20 Rand. And that 20 Rand that remains is an asset to the business. So the same applies here. When we paid for the rent, we paid for 4 months, but we paid at the beginning of the month. So we haven't used the premises yet. So once we come, for example, to the end of January, will the full 48,000 still be prepaid? No. Then 12,000 Rand of that, or portion of that, now becomes an expense. So we must always keep in mind now, when we're working with accounting, what is the date of the transaction and what occurred in the transaction. So let's look at transaction number 4. Transaction number 4 says that on the 2nd of January, Simon transferred 120,000 Rand from the bank account into a fixed deposit account earning interest at 5%. So we have the bank account involved, and we have an account called fixed deposit. The bank account being an asset, fixed deposit also being an asset, and we know that fixed deposit is a financial asset. We took money out of the bank account, so what's happening to the bank account? It's decreasing. We put that money into the fixed deposit account, so the fixed deposit account is increasing. Amount 120,000. Transaction number 5. It says that on the 2nd of January, Smart Concepts purchased furniture and fittings for 240,000. This was paid from the funds in the bank account, and the expected useful life of the furniture and fittings is 5 years. keyword there, it says that we paid, so the bank account is involved, an asset. We paid for the furniture. Now keep in mind, furniture and fittings is different from equipment. Right? Your filing cabinets, or in your lecture theaters, your desks that you sit on, right? Your desk, your chairs, those are furniture. Whereas the computer in the lecture theater and the projector in the lecture theater, that's classified as equipment. Right? So we must know the difference between what is furniture and what is equipment, not the same asset. So the bank account is decreasing because we paid 240,000 rand. Then we have the furniture and fittings account increasing because we purchased furniture with 240,000 rand. We move to transaction number 6. It says on the 5th of January, Simon Smart purchased supplies of stationery for 5,000 rand, as well as supplies of computer parts for 12,000 rand, and again all of these were paid in cash. So we know we paid for it, so the bank account is involved, an asset decreasing. Now we can do this separately, so we say we paid 5,000 rand, and that payment was for stationery. We know that stationery is also an asset increasing with 5,000. Right, so remember, if you purchase stationery, it's an asset. Once you use it, then it becomes an expense. So we also purchased and paid for, so we paid, we decreased the bank account. We paid for computer supplies. We paid for computer supplies. So if you say computer supplies or suppliers or consumable stores, those are all fine. That's increasing with 12,000. Now keep in mind, your computer supplies or your consumable stores, right? That is what you use in the production of providing your service. For example, if a cleaning company purchases its cleaning liquids, like its bleach, those items, we use it in providing our service. If we use half the bottle of bleach when providing our service, that half that we used, that's an expense. The half that we still have over, remaining, that is an asset to the business. Right? So when we have our supplies, it's still an asset to us. The part that we've used is an expense. The part we still have left over, that's an asset. We look at transaction number 7. Transaction number 7 says that on the 7th of January, Smart Concepts opens an account at Computer World, the supply of its inventory. So we just opened an account, we didn't pay for anything, we didn't purchase anything, we didn't sell anything, we didn't render a service, so no actual business transaction took place, an accounting transaction. But we have to state that in that transaction there is no entry, because we want you to be able to identify when there is no entry to record. Then transaction 8. So now we're going to purchase inventory in transaction 8. It says on the 10th of January, Smart Concepts purchased inventory of 60 computers from Computer World at the cost of 10,000. The total amount owing is to be paid. So it says we purchased the computers and we are going to pay. So did we pay? No. So we owe them. When we owe them, what do we call it? Accounts payable. It's a liability to the business. And that's increasing with 600,000. Right, that's the 60 computers times 10,000. We purchased the computers to sell. As soon as we buy anything to resell it, that is inventory increasing with 600,000. So that's the first part of the exercise for this video. The video will then continue in the next video. We will be going on with the remainder of the transactions, and then we can record it in the accounting equation.